Casey, if we look back over the last 2.5 years from the beginning of this rate hike, it seems like it's been a pretty tough time in commercial real estate. When you look back even further and you look at the GFC from the 2008-2009 timeframe to today with the quantitative tightening cycle that we're in, how do those two periods compare and differ when it comes to fundamentals and when it comes to liquidity?
Yeah, actually interesting. From a fundamental standpoint, they were very different. During the global financial crisis, real estate was in crisis. You had falling jobs or job losses. You had too much supply going into that time period. So fundamentals were down. And you also had a repricing period. During this time, during the quantitative tightening, fundamentals have been relatively strong across the real estate sectors in everything other than office. So fundamentals, very, very different time period, feel very, very different. From a liquidity need standpoint, it's actually, they've been very similar. The amount of capital that wanted to come out of the real estate sector in core real estate, for example, which is how institutions typically access their real estate, was about the same. So they were looking to redeem capital out of their investments at about the same level that they are today. I think that's really interesting given the differences in the fundamentals. I also think it's interesting that during the global financial crisis, it was really wrapped up in 8 quarters. This time we've passed 8 quarters and are moving into the 9th and 10th quarter here. And I think that's also really interesting given the strength in the fundamentals and something that we've been scratching our heads at.
And so if we look, as we've seen long periods of positive real estate returns going back over the last 3 cycles. You've mentioned that we're kind of in overtime now when it comes to this repricing cycle today. What makes you think that we're towards the end of that? What are the indications that you're seeing?
Yeah, we've seen capital starting to flow back into the market. We've seen values come off of the bottom. We really hit the bottom in commercial real estate in the middle of 2024, and we're able to see positive returns in the back half of the year. So yes, I think we've already hit the bottom and are starting that next phase in the cycle. And that's a really good time to be an investor in the asset class.
And when it comes to investors in the asset class, who do you see as the first movers when it comes to allocating capital in 2025? And what have you seen historically when it comes to investor behavior with other pockets of real estate?
Yeah, I mean, there are really 2 large groups who drive it, and we kind of segment them into more traditional institutional investors and then retail investors. Now, the vehicle in which they access these, it could be daily liquid REITs, it could be semi-liquid real estate investments like interval funds and non-traded REITs, or it might be institutional private funds. The first movers are typically institutions. Now, that said, if you look back historically, all groups of investors stay in the asset class too long when it's already peaked, and they typically are continuing to sell well after the bottom, at least a few quarters. One thing that we've noticed is the institutional investors are the first movers in both of those groups. And what we're seeing as the market had bottomed in 2024, we're starting to see the first movements in that institutional marketplace. What are those first steps? The first steps are rescinding their redemptions in those institutional funds. So we saw that in the back half. The second step is new capital coming into the market. We're seeing that in the first half of, or the early days of 2025. So we think it will go institutional capital first, retail capital after another quarter or 2 of positive returns in the asset class.